Ladies and gentlemen, good morning. And for those in the US, good evening. Thank you for joining today's exclusive live webinar on pitfalls in a post-pandemic world, deglobalization, and asymmetrical normalization. My name is Serena. I'm from the Public Policy Institute at our Hong Kong Foundation and your MC today. On behalf of our Hong Kong Foundation, I'd like to extend a very warm welcome to all guests, members of our Hong Kong Foundation, friends from the media, and members of the public join us now. Today, we're honored and delighted to have Professor Stephen Roach speaking to us live from the US. Professor Roach is a senior fellow at Yale University's Jackson Institute for Global Affairs and a good friend of Hong Kong and the Foundation, as he had been the former chairman of Morgan Stanley Asia, based in the city. Without further ado, may I invite Professor Roach to share with us his thoughts on several observations and challenges in the post-pandemic world. Professor Roach, please.
Thank you very much, Serena. It is a pleasure to be with you today. I've been a big supporter of our Hong Kong Foundation, and it's a particular pleasure to present my views to you in this timely and important insight forum. There's a lot of cross currents at work in the world today, from Asia to the United States, and we can't hope we can't hope to cover all of them in the time that we have in this meeting. But I thought I would try to address some of the important forces shaping the economic response to this pandemic in terms of the downturn in the world economy, and then the consequences that has for the recovery that we can expect. And I'll use a series of slides to illustrate my approach to this daunting task. So I'd like to just start out with setting the stage and give you a sense of what the world looked like before the pandemic hit. On the left is a slide showing annual growth rates of the world GDP beginning in the year 2000 and going through 2021 with projections for 2020 and 2021 provided by the International Monetary Fund in their update pre-pandemic of January of 2020. And so a few things to note about this slide, because I'll rely on this as we go through it. The vertical bars are just the annual growth rates in world GDP. There are two horizontal dash lines. The first one shows you the trend growth in the world economy, which over the past 40 years has averaged 3.5%. And then the second horizontal line, the dashed red line, is drawn at 2.5%. Anything below that, we typically consider to be a global recession. So pre-pandemic, the IMF had lowered its estimate for 2019 to 2.4%. To me, this was a big warning sign because it pointed to a world that was they lowered their number to 2.9%. It was only 0.4 of a point above the official global recession threshold of 2.5%. That was a worrisome development because it was not only the weakest year since the global financial crisis of 08 and 09, but it was only a thin margin away from the 2.5% threshold. So I wrote about this in early pre-pandemic 2020, and I said that the world was too close to that recession threshold, and should there be a shock, we could easily go into recession. I also noted that the world economy for a number of years has been heavily dependent on China. And so any accident in China would have dire consequences for the world. And of course, I had no idea what was going to happen. But when China began its lockdown at the end of January, it became quickly evident to me that that was the tipping point that was going to make my concerns come to pass. And that's exactly what happened. You can see this now, same chart, longer time period, but now reflecting the latest forecast of the IMF that was just released a couple of weeks ago. And we've gone from 2.9%, the orange vertical bar again in 2019, to an IMF estimate of a minus 4.9% drop in world GDP this year. We've never seen anything close to that. The worst we've ever seen prior to that was in 2009, when the world output, according to the IMF, contracted by only 0.1%. I've added one more line in here just to give you a sense of how severe this downturn is. And that shows you the deviations of the blue bars from the trend growth, 3.5%. So we're subtracting global output from its long-term trend. And that's the best way to judge the severity of any recession, because the world on average expands by about 3.5% a year. So you can see in 2009, during the global financial crisis, labeled GFC, the slight contraction was actually a big miss relative to the trend. It was 3.6 percentage points below the trend. And now the IMF is projecting this minus 4.9% for 2020, which is a massive 8.4 percentage points below the trend. And so that is a very serious problem. And one that is a deviation from trend nearly 3 times that which we experienced in the GFC. I would note that the IMF has, recovery penciled in for 2021, the green vertical bar, plus 5.4%. That sounds like a big number, but compared to the trend, it's only 1.9 percentage points above the trend. So following a shortfall from trend of 8.4, we are only recouping a small portion of the foregone growth. Now, the next slide shows you the debate that we're having over economic recovery. And there's lots of different patterns that we can focus on, but I've chosen to focus on 3 of the most popular. The one that will be over quickly and we'll forget about this in a very short period of time, the great V-shaped recovery. The one in the middle is the U-shaped, where you go down hard and you stay at a depressed level for a while before resuming economic recovery. And then there's the worst of them all, the L-shaped, where you go down in a sharp recession and you don't recover very much at all. And that is more of a Japanese style lost decade or multiple decade syndrome. I've put down some characteristics of each of these patterns of recovery that you should keep in mind. And I would just say at the outset, for the V-shape, you really need to bring COVID under control very quickly, and then things will snap back, hence the notion of the rubber band. And with policy having provided so much stimulus, the big bazooka will have a very powerful recovery. And both the supply and the demand side of the affected economies will respond. The U-shape, it's going to take longer to control the virus. And while there may be some early signs of normalizing the supply or production side, the demand side is going to be slower to come around. So the normalization is asymmetrical. And then for the L-shaped, you bring back economic activity too quickly, you have a relapse in the virus, and that leads to a much more severe and lasting behavioral capitulation by consumers and even companies. So which one will it be? The best way to try to understand the dynamic here is to look at some modeling that was done by Richard Baldwin in an article that he published in March of this year on the trade-off between the infection curve and the business cycle. And on the left, you see a simple illustration of the modeling that he developed. The red line on the top shows you what happens to new COVID cases without any lockdown or containment policies. And the new case curve spikes up dramatically, and then through some miraculous process comes down. And because there's no lockdown, the recession, while it's a severe one, is not nearly as bad as the blue line on the bottom, where there is a lockdown to limit the increase of infections. And I would just point out that this notion of a relapse, everybody thinks there's going to be a second wave and possibly a third wave. It's not something that is really that comes out of thin air. On the right, you actually see the mortality rate from the influenza, the Spanish flu of 1918 and 1919. This is UK data where there were 3 waves of infection, and the worst of the mortality, unfortunately, came in the second wave. So this trade-off between containment or lockdowns and infections needs to be taken very, very seriously. Now, what does the data show right now about the nature of the response? Here we compare China and the United States. China, obviously, the first to be hit. And in both cases, the production response is measured by Purchasing Managers' Indexes, PMI, has been very rapid. And as China was hit first, it responded first. And the US production response has also been quite rapid. But in both cases, there are lags on the demand side. Consumer spending increased sharply in the US and in China in the months of April and May. But in both cases, the spending level, while it's risen sharply, has recouped only a little bit more than 1/3 of that which was lost during the lockdown. So I would conclude here that the normalization that's occurred thus far has been asymmetrical, more on the supply side than on the demand side. Maybe that'll change. Time will tell. This is a very complicated slide, so I will be brief on it. But I think to understand the asymmetry between supply and demand, you need to look very carefully at a detailed breakdown of the employment adjustments that are occurring in economies around the world. And this is a very detailed breakdown of the US employment since the COVID crisis hit. And we basically break down employment into three groups of industries. Essential industries that need to stay open, like grocery stores, pharmacies, gas stations, and utilities, and a few others. The face-to-face services industries, largely, where the bulk of the employment adjustments have occurred: restaurants, hotels, retail trade, arts, entertainment, recreation. These account for about 55% of total pre-COVID employment in the United States. And then there are the so-called remote industries, where courtesy of technologies like I'm speaking with you on today, you can keep the flow going and just relocate your employees to their homes or other safe modes of a work environment. And what happened was, when the labor market collapsed in February and especially April in the United States, we lost 21 million private jobs in 2 months. We've never seen anything close to that. And the bulk of it, as the pie chart shows you on the right, was in the face-to-face service industries, where 81% of the job loss occurred, and much smaller declines in essential industries and remote industries. I show you on the right the healing ratio, how much of the loss has been recouped in the last couple of months, and on balance, somewhere between 37 and 41% of the jobs that have been lost have been recouped, which is, good news for those who are working again, but still raises serious questions about how much further we need to go, especially in these areas where social distancing is likely to produce dramatic and lasting structural change. There's been some interesting research that describes the impact of earlier pandemics. This is a study that was produced, again, just a few months ago by some economists at the Federal Reserve Bank of San Francisco and the University of California at Davis. And they looked at the impacts of 12 large pandemics going back to the Black Death of the 14th century. And to qualify these serious pandemics, each had a job loss of, a death rate of more than 100,000 in terms of mortality. And as you can see, the blue line at the bottom shows that the impact of these major pandemics has a long shadow. The impact lasts for a long, long time. And so based on earlier pandemics, that in and of itself casts doubt on this optimistic call for a V-shaped recovery. It is associated with lower interest rates, which would allow fiscal authorities to provide more stimulus to respond. So my vote is for an asymmetrical normalization that gives us an outcome that is, while it may seem like a V right now, that is not a sustainable outcome. I would look actually for the letter that I haven't shown you thus far. It would be a W, one that we would associate with a double dip. The rebound that we're experiencing right now will be followed by another downturn in the economy. This raises a lot of questions about the global environment if that were to occur, and I've listed some of the issues at the bottom that I want to briefly take you through: decoupling, deglobalization, trade diversion, and then finally the outlook for the US dollar. I can see I've already spoken too long, so I'm going to go try to pick up the pace a little bit more. The deglobalization debate is very important. Globalization, of course, has been the overarching force that has been that describes the integration of the world economy over the past 25 years. And there are many that fear that globalization is coming to an end. I'm not certain that's true, and I'm hopeful that what we're seeing right now is only a temporary pause in the integration of the world. But make no mistake about it, there are a lot of politicians in particular, especially in the United States, pushing against the offshoring of globalization and arguing that we need to bring business back home. Now, if that were to occur, I think that would be a problem for businesses and consumers alike. And of course, right now, the bulk of the focus for deglobalization has been directed at America's largest piece of our big trade deficit, China. The point of this slide is to illustrate that while the Chinese piece of our trade deficit, the red bars at the bottom of this slide, has come down, in large part a reflection of the trade war and the tariffs that President Trump has placed on China, that the Chinese piece of our multilateral trade deficit has come down much more than the trade deficit itself. And that means that our deficit with other countries has expanded more sharply as a result. And hence, trade has been diverted from China, our low-cost supplier, to higher-cost sources of trade, in particular Mexico, Vietnam, Canada, Switzerland, and Ireland. We have a multilateral trade problem that you cannot address with a bilateral attempt to narrow the issue. So I think that's a very important point. Secondly, so much of our trade growth now occurs through global value chains, GVCs. In fact, a study from the IMF recently suggested that increased GVC activity accounted for nearly 75% of the total increase in global trade over the 20-year period, 1993 to 2013. Other research has indicated that it takes a long period of time to construct these value chains, and you don't simply move from one value chain to another, one component of sourcing to another quickly. It takes a long time to alter these so-called sticky supply chains. And so the notion that we can just push a button and go from offshoring through GVCs to reshoring, I think is actually ludicrous. Now, recently there's been some discussion about what all of this means for currency markets. And I've taken a pretty strong view that in this post-COVID world, one of the big surprises is going to be a very sharp decline in the value of the US dollar. And I make my analysis on the basis of two considerations. One, the link between our domestic savings rate and our current account deficit, and two, fact that America is squandering its global leadership role on multiple fronts. I would just point out, as this slide shows you, that the dollar has been very strong since July of 2011. It's risen by about a third on a broad trade-weighted basis over that period. I would also point out that this strength in the dollar has occurred at a time when our domestic savings rate pre-COVID was extremely low. The domestic savings rate, which includes the saving of businesses households in the government sector, shown on net terms, adjusted for depreciation, was only 1.4% in the first quarter of 2020, pre-COVID. That is 1/5 the 7% average over the 45-year period from 1960 to 2005. That's the way it was before COVID hit. Now, this domestic savings rate, which is so low, is going to go sharply into negative territory, courtesy of exploding government budget deficits, which will average 14% of GDP this year and next. And that means that our domestic savings rate is going to go sharply negative over the next few years, and we will have a record current account deficit as a result. And so I look for the dollar to drop by 35% on a broad trade-weighted basis over the next few years in a way to facilitate the current account adjustment. 35% sounds like a big number. We've had this comparable drops before. In the 1970s, the broad trade-weighted index dropped 33%. In the mid-'80s, in a very short period of time, it also dropped 33%. And in the early 2000s, we had a comparable 28% drop. People ask me immediately, if you think the dollar is going down, how could it ever go up against any other currency? This is the so-called TINA defense. There is no alternative, TINA. And I think that is really the wrong response. I look for the dollar to go up against two major currencies, the euro and the renminbi. And I think that the euro is clearly the most unloved major currency in the world. It's down about 15% on a broad trade-weighted basis over the last 10 years. I've been a Euro skeptic for most of my career. I've always thought that the European Monetary Union is going to fall apart, and it never has. I think we saw very clearly that the euro defied the sovereign debt crisis in 2011 when the president of the European Central Bank said, we'll do whatever it takes to defend the euro. And we've had a comparable moment this year when Angela Merkel and Emmanuel Macron came together to basically establish a pan-European 750 billion euro next generation EU fund, complete with the promise of a sovereign pan-European bond issuance. I think Europe will come out of this extremely well. And with respect to China, while the renminbi has been up a lot on a broad trade-weighted basis over the last 15 years, I think if China stays the course of structural reforms and continues to open up its financial system, there's room for further RMB appreciation as well. Also at work, though, is the fact that America is squandering its global leadership role, leading the way in deglobalization, decoupling, trade protectionism, and then we failed miserably at containing the coronavirus. And of course, we have an unprecedented racial upheaval in the United States right now. If you look at this chart at the bottom, this compares new COVID cases, the US, the blue line, Europe, the purple line. Which currency would you want to own if this is a proxy for relative performance in dealing with public health issues? This chart, by the way, is up to date as of this morning. To say that America is experiencing a problem in containing COVID-19 is a gross understatement. Never mind what our president says. And I guess the final point I would make is that we do have as a consequence of this saving and debt problem, we're going to quickly be in unprecedented territory with respect to our debt to GDP ratio. This shows you public debt to GDP over a long sweep back to almost the founding of the United States. The previous record was 106% in 1946, post-World War II, and we're going to probably hit 130% of GDP in the next few years. I'd point out that we recovered from that debt overhang very sharply in the aftermath of World War II by cutting our annual accumulation of debt slightly, but largely by reflating our GDP with a combination of real GDP growth post-World War II, but also with accelerating inflation. And that raises the possibility that we may have to allow for more inflation once we get out of this COVID crisis as well. And if that occurs at a time when we have a balance of payments, a current account deficit that's at a record, we could have some funding problems that would entail sharp increases in interest rates, reminiscent of the stagflation of the late 1970s. I'm out of time, but I just need to touch on a couple of other things, and so bear with me. I'll do this very, very quickly. In thinking about the big events that are likely to unfold over the balance of this year that will set the stage for the post-pandemic world, obviously our presidential election is the top event risk to think about. The screenshot you see on the left with the O'Donnell and Associates logo on the top is a page taken from a strategy document that was prepared by this group, O'Donnell and Associates, who is the consultants, the strategy consultants for the Republican Party. They have produced a 57-page document published in mid-April called the Corona Big Book, which lays out the U.S., the Republican Party's election strategy. And their strategy is very simple. When it comes to the virus, this is the big issue. And they're saying to their party loyalists, do not defend Donald Trump, simply attack China. And that's because Trump is not defensible. I just showed you our horrible record on COVID containment. And so attack China for the virus and for the cover-up and saying that America did its best under the difficult circumstances. I've written about this. There's an article cited right below that that I wrote with a good friend of mine, Wei Jianshan of Hong Kong, that takes this argument apart. But I will tell you that the political debate that the O'Donnell Strategy Group has identified resonates very much with the American public, where the unfavorable ratings of China on the right have never been higher. The case that the trade advisors make for going after China is that China, of course, has the largest trade deficit, the piece of the U.S. trade deficit. But as you can see from this very busy slide, China is but one of 102 countries we have trade deficits with. We have a multilateral problem that you cannot address by going after a bilateral piece. The result of doing that is the trade diversion I showed you earlier. And, we've done this before. In the late 1980s, we went after Japan, and the purple bars show you that the Japan slice of our trade deficit was just as big as the that China slices today. And Japan suffered greatly from the pressures that we brought to bear on them by forcing them to overvalue or to let their yen appreciate sharply. And we've tried similar things with China, but knowing the experience of Japan, China has not succumbed to that pressure. And then finally, I would just point out that we have this phase one trade deal that was struck just before the virus hit, and the deal was a lousy deal from the start. It would not have accomplished much of anything, and you can see the progress that's been made thus far relative to the trajectory. This borrows from the work of Chad Bone of the Peterson Institute of International Economics. We're nowhere close to hitting the stipulated trajectory of phase one. And so I will leave you with this slide and then turn it over to the Q&A, that this is likely to be an enduring conflict, even if there is a change in administrations from Republican to Democrat in January 20th of 2021. Cold War may not be the right label to call the enduring conflict, but I think the pressure between the U.S. And China is likely to be an enduring feature of this post-pandemic world. And I would just draw your attention to the table on the bottom right of this slide. There's a perception in America that we're good at winning Cold Wars. We won the first one, and we'll win the second one. And the point of this slide is that our economy is much weaker today than it was during Cold War 1.0 with the former Soviet Union. So, I think there's a lot to digest as we move into the post-pandemic world, assuming we're ever able to get control over this horrific virus. And I hope I've touched on at least some aspects of the scenario that you find of interest. And I will stop at this point.
Thanks, Professor Roach, for the thought-provoking sharing. I'm Stephen Wong, Deputy Executive Director and Head of Public Policy at our Hong Kong Foundation. I'm your host for the next session, the Q&A session. And so please, if we would invite you to write questions from our guests, members of our Hong Kong Foundation, media, and the public. And our first question, I would like to invite Professor Lawrence Lau, a world-renowned economist and previously the Vice Chancellor of Chinese University of Hong Kong. So please, Professor Lau.
Thank you, Stephen, and thank you, the other Stephen, for a most insightful and comprehensive presentation. I really enjoyed it. And I agree with you that there are two things that are the new normal. One is that the pandemic, the COVID-19 pandemic, is going to the new normal. It might come up with a second wave, perhaps a third wave, but I think other viruses will come. So we really have to be prepared. And this means we have to improve healthcare infrastructure and services and maintain social distancing. This is a new normal. But the other new normal is what Steve also said, is that the competition between China and the US will also be a new normal, sort of regardless of the change of, if there's any change of administration in November, it will be the new normal for, I think, at least another decade or so. So we have to be prepared. I'm optimistic that it will not turn out to be a hot war, but it will actually be with us for a long time. I actually want to ask Steve the following question, which is an intriguing question, and that is about the devaluation of the US dollar. As we all know, the US dollar today is actually the most widely used international medium of exchange. And I don't see on the horizon anything that might replace it in the short term. But I want to ask Steve, but I think what Steve said is absolutely right, that the US Federal Reserve Board has been printing a great deal of money. And then there's also a rising public debt and the falling savings rate. They're all sort of interrelated. What I want to ask is actually the following, Steve. Do you think this devaluation, expected devaluation, is going to come precipitously all of a sudden, or whether it is actually going to come gradually over time? So that is my short question to Professor Roach.
Thank you very much, Larry. That's a great question. I'll be brief. I think what we've learned from this last few months is that COVID time moves at warp speed. The world went from solid growth to the weakest growth in history in a short period of 2 months. So I actually think that the dollar's sharp decline will be sooner rather than later as our budget deficits explode before our very eyes in the face of an already weak savings rate. To your earlier point, though, I don't see this ending the dollar's role as the dominant reserve currency in the world, however. I think that point is well taken. But there's a secular decline in official holdings of the dollar in terms of its share of foreign exchange reserves. In 2000, the dollar accounted for a little over 70% of official foreign exchange reserves. Today, that number is a little bit less than 60. The next closest is the euro, a little above 20%. So the dollar is, on a long-term basis, losing its share, but still the dominant sort of source of foreign exchange reserve holdings by central banks around the world. That does not mean the dollar can't fall sharply, though. And the dollar fell very sharply as I raced through my slides in the 70s, again in the mid-80s, and in the early part of this decade as well. And I'm looking for that pattern to repeat itself once more, even though it will still maintain its role for the time being as the dominant reserve currency in the world.
Thanks, Professor.
Thank you,
Thanks, Professor Roach. May I invite the next question from Mr. Zhou Ai, Managing Partner of McKinsey Greater China. He joined us this morning at our Hong Kong Foundation. Joe, please.
Thanks, Stephen. Professor Roach, thank you so much for a very insightful presentation, and thank you for our Hong Kong Foundation for putting this together. I have a rather short question, but something that I'm very perplexed with. The one asymmetrical part that I'm seeing is basically the capital markets, right? So you're painting a rather grim view of kind of how this can pan out, much rather, U-shaped or a prolonged kind of L shape coming up gradually. But the V shape that we're seeing is actually in the capital markets, right? Apart from maybe 2 months, basically we are seeing a massive V happening, right, in equities. Is that something that we'll see the asymmetrical between the economy and the capital markets, or are we, just like the coronavirus, we're going to see different waves of the capital markets coming down, or is the monetary policies, having such a big effect, right? That the decoupling between what we're seeing in the stock market and valuations of equities versus the real economy is kind of reaching something that will be a new normal for us. Thank you.
Yeah, I was afraid I'd get a question like that. You're entirely right. The global equity markets have very much demonstrated an extraordinarily sharp recovery. For people who look at stock markets over a long period of time, whenever you see a drop, the likes of which we saw in late March, and that was, again, extraordinary, you would expect a recovery to ultimately give way to a retesting of the late March lows. That never happened. All I can say is, I'm an economist. I'm not a stock market strategist, but enjoy it while you can, because if I'm right and the normalization on the real economy side is likely to be asymmetrical, and if this statistical rebound that will be evident in the third quarter numbers gives way to a second downturn in the economy, then the markets are totally unprepared for that, and they will correct sharply again. But there's a lot of other factors in play here. We've touched on some: the U.S. election, the currency outlook, the monetary policy outlook, and even the outlook for COVID mitigation through either therapeutics or a vaccine. Right now, the markets, the U.S. equity market was down a little bit today, but it was up very, very sharply over the last few months, much more sharply than literally anybody was looking for. It's got nothing but good news in the price. And so there's very little room for disappointment. And I think that's overly optimistic. Thank you for your question.
Thanks, Professor Roach. And also, I would like to invite Mr. Elliot Win, General Manager of China Development Bank, Hong Kong branch, and he also joined us at our Hong Kong Foundation this morning. Mr. Win.
Okay. Thank you, Professor. It's my pleasure to take part in this forum and raise a question. My question is that before and after this pandemic, I think this is totally different. We know that China's 4 decades of net-breaking development have arisen from demographic bonus, foreign investment, which comes mostly from Hong Kong as an international financial center, and the WTO access to the world market. With increasing risk of deglobalization and decoupling presently, along with fast aging population, China's future could be negatively affected by a likely decline in human resources, FDI, and access to the international market. Therefore, the Chinese government is increasing domestically demand by, for example, adopting an improved new infrastructure policy focused on 7 areas, including 5G networks, intercity transportation, and the rail system. So my question is that, mindful of these risks, which how should foreign companies evaluate investment potential in the Greater Bay Area, which including Hong Kong, Macau, and the Guangdong provinces? And what would you suggest to China's policymakers, including the need for strengthening Hong Kong as an international financial center? Thank you.
Wow, there's a lot in there, and I will simply say that it would be presumptuous of me to try to offer advice to the People's Republic of China, which has done such an extraordinary job since the reforms and opening up of the late 1970s. But I think this COVID shock just underscores what we've known about China now for quite some time. And that is that an economy that drew such extraordinary support initially from exports and increased fixed investment in productive capacity needed to come up with a new strategy. And this is a debate that's been going on in China since 2007. There's been, I think, great agreement inside of China that the need to shift from exports and investment to domestic demand, especially internal private consumption, is increasingly urgent for China. And the political and COVID-related threats to globalization and what this means for external demand makes that reform imperative even greater today than it was back in 2007. So China needs to stay the course, there's a lot of strong political anti-China winds blowing in the world, but I'm hopeful that strong winds that are blowing right now against China will subside. And like I said earlier, I don't think they're going to stop blowing even if there's a change in U.S. administration, but I'm hopeful they would be less severe. The last thing China needs to do at this point is to alter its course and move away from the reforms in terms of stimulating internal private consumption, its services sector, focusing on indigenous innovation, new waves of urbanization, including the Greater Bay Area. All of that was on the books and needs to continue. I'm hopeful in the same sense that China recognizes the need to promote activity in its private sector, to continue to focus on deleveraging, and to address long overdue reforms needed in its state-owned enterprise sector. These are all subjects that have been actively debated in China for well over a decade, and I think China needs to stay the course.
Thanks, Professor Roach. There's a question from South China Morning Post, a friend from media. Professor, you mentioned the recovery shape will be W-shaped. Does it apply to the whole global economy, or are there other economies that will escape from this W-shaped recovery? Are there any differences across the global economy for this shape of recovery?
Yeah, look, there's no way you want to generalize, one letter of the alphabet on 200 countries of the whole world. And I don't even know if a W is appropriate. All I'm suggesting is that we went down more sharply globally in the second quarter of this year than the world has ever gone down in its history. That was a deliberate contraction caused by the containment measures that we now know as a lockdown. As the lockdown gets eased, then statistically there will be a sharp rebound. And so the third quarter numbers will look better. I don't think we'll be able to sustain that statistical increase into the fourth quarter or even the first quarter of next year. Even if we were not going to have a relapse, I think it would be hard to sustain that. If we have a second wave or a relapse in the virus, then it'll be a very volatile bottoming process for the world with periodic fits and starts to the recovery that'll be manifested through equal volatility in financial asset prices as well. Some countries will do better than others, but to the extent that the world is very much interdependent, these will have reverberations across all major economies of the world, including China.
Thanks, Professor Roach. A question from Xinhua News Agency. You talked about the decoupling between U.S. and China potentially, but with regards to the COVID-19, do you think there's any sort of opportunities of cooperation between U.S. and China to work together to recover the economy as well as to in the face of the virus?
There is enormous potential for collaborative work between China and the United States to address the virus, to engage jointly in developing therapeutics and research on vaccines. I wrote an article about this. It was published by Bloomberg a few months ago, and I was roundly criticized by my friends and colleagues in the United States for saying that we have no desire for collaboration. And yet, I stand by my view. The pandemic, by definition, is global. It involves all major countries of the world. And China has done a remarkable job in containing this horrible disease. We may not, in the United States, be able to replicate the types of severe practices that were put in place in China to contain its initial outbreak of COVID-19. But there's so much we can learn in terms of the research into the science of addressing the disease, the hope for a vaccine, the sharing of detailed data on the incidence of the virus by different demographic groups that will help us in understanding the way in which this horrible disease impacts communities and countries. There's a lot that the U.S. and China can do to convene a consortium of leading scientists around the world, leading public health officials around the world. Dealing with a pandemic is an opportunity for collaboration. And yet, if we try to address it on a fragmented basis, we will be running uphill. It's too much for any one country to do on its own.
Thank you. A question from commercial radio in Hong Kong. And you mentioned that there is a sharp decline of the US dollar that is coming sooner rather than later in terms of timing. And so one is to confirm your view on that. And second is my question really, that obviously you mentioned that US dollar dropped by 30% in the 70s and 80s before, so it's nothing new. But in those periods, it doesn't affect the status of the US dollar as sort of the international dominant currency. So my question then to you is, would this drop of 30% this time affect the status of the US dollar as the dominant world currency?
Well, again, I tried to address that, but let me just make it clear. First of all, in terms of timing, I do think it'll be sooner rather than later. I think this is 35% on a broad trade-weighted basis. Be the dollar against, a large group of our trading partners in inflation-adjusted terms, and I think it will occur over the 2020 to 2021 period. So within the next year and a half. Secondly, I do not think, and I want to stress again, this will bring an end to the dollar's dominance as the world's reserve currency. But I think there's so much in the way of questionable performance of our leadership role in the world, leading the charge against globalization, leading the way in trade protectionism, arguing for decoupling, and then, today announcing withdrawing from another global institution, the World Health Organization, heaven's sakes, in the middle of a pandemic. Our performance as a global citizen can be drawn into serious question, to say nothing as being a global leader. We are not performing in any way whatsoever in the leadership capacity that the world has grown accustomed to expecting from the United States. Does this lose our dominant role as the world's reserve currency? Not technically, but it certainly raises serious questions about whether or not we're deserving of that role in the future. And that's something that needs to be addressed in our upcoming presidential election and the administration that follows.
And a follow-up question from Joseph is also to specifically ask, care to comment on the time horizon of 35% fall in the US dollar and the possible triggers?
Yeah, I think, Joseph, I would expect the bulk of it to occur by the end of 2021, sooner rather than later. We're working on COVID time, where things happen at warp speed. Trigger event, again, budget deficits and a massive widening of our current account deficit. And I expect that to be far more evident toward the end of 2020 and moving into 2021. So the numbers will bear that out. And as the magnitude of our current account deficit becomes evident, I think the weight of that will put significant pressure on the U.S. currency. And again, I draw your attention to the chart I showed you on new COVID cases, the U.S. Versus Europe. We're setting new records to the upside. In Europe, the numbers are close to zero. Which currency would you rather own if we have still problems with this pandemic moving into 2021?
There are a number of questions from the media, really, to invite Professor Roach to talk about Hong Kong, specifically being caught in between a crossfire between the U.S. and China tension, and what is the potential impact on Hong Kong on various talks of sanctions, on the various relationship issues between China and U.S. And what would be your advice, your views on the development in the future from a Hong Kong perspective?
Well, I think, I was hoping you would say that we're out of time, and so I don't have to answer such a controversial question. There's no way I could answer that question without causing controversy either, in the United States or in Hong Kong. But I will say the following: the instability that has been evident in the streets of Hong Kong over the past year was simply not sustainable. And those of you're Hong Kongers, you know that. And so something had to give. And the Hong Kong government was not able to control the demonstrations. And so there's now a new legal framework that is aimed at addressing that. It's not clear that will work either. I'm hopeful that the situation will be more stable and that Hong Kong's long-term role as a major international center will not be as adversely impacted as some in the West fear. U.S. politicians are taking advantage of what I showed you earlier and was too brief on it in the Corona Big Book, and that is to blame China for everything. And so, in a period where the Trump administration is in serious trouble, not just for COVID, but for other issues. We haven't even talked about the racial unrest in the United States. The Hong Kong issue will get highlighted even more by partisan U.S. politics. And that's unfortunate, but that's the reality of our highly polarized political climate in the United States. if I have succeeded in ducking the question, then I've accomplished my objective.
Thank you. Professor Roach, really, there are still a lot more questions, but given time, I wanted to thank you all those who sent in questions, as well as thank you all the special guests that asked questions.
Thank you very much for your time.
Thank you, Stephen. And this concludes today's live webinar. Once again, thank you, Professor Roach, for sharing with us your valuable insights. There will be a group photo after the webinar, so please stay with us. Also, special thanks to all our supporting organizations. Our next Insight Forum session will feature Mr. Joseph Yam, who was the Chief Executive of the Hong Kong Monetary Authority from its establishment in 1993 to 2009, and is currently a member of the Executive Council of the Hong Kong SAR government. Mr. Yam will be sharing his insights on the outlook of Hong Kong as an international financial center. Please stay tuned for more information on our Hong Kong Foundation's main Facebook page and the Public Policy Institute's 政策.正察 Facebook page. It's been a pleasure speaking in front of you today. Thank you all for joining. Stay healthy and have a great day.